In this video, traders, we're going to look at should you hold Forex trades over data or stock trades over earnings? In other words, should you give up some of the risk control you have and why? And really, is it a sensible thing to do? Stay tuned. Hey guys, a very warm welcome to you. All right, so should you really hold trades over data? So in other words, if you had a Forex trade, you're coming up to non-farm payrolls or interest rate announcements, and you know that's potentially market moving, should you hold over that? Or should you close a position? What should you do? Same with stocks. You come into earnings, and you know earnings is a binary event, good or bad. You know, maybe the stock does nothing, maybe it shoots up 10%, maybe it shoots down 10% or more. So the idea is, the question is, should you do it? Now, the pros and cons of this, guys, if you think of the negatives are that if you're on the wrong side of it, you're going to have a lot of damage to your account. So you need to think about the damage that could be done. So if your position size is maybe super large relative to what you normally do, then you've got to think, well, what actually has happened before? So go back and look and see, hey, is this something that is an extreme mover? And the other thing to look at, guys, is this something everyone's looking at, particularly for jobs data and stuff? A lot of the time, it's not that meaningful. People know that the cycle is kind of in the midst of a cycle, everything's okay. If you're at the turning point of a cycle, or if you're like about to recover, or you're dipping down, or everyone's looking at an interest rate expecting this, then there's more chance of a surprise. If there's no surprise expected, you're probably not going to get anything. You're probably going to get the classic spike, back down, and nothing. In which case, you might be more inclined to hold the trade because you want the trend to resume after data. You know, maybe you've been in an uptrend, you sit, and then you're expecting it to continue, and that's perfectly acceptable. And so you might think, you know what, I'm prepared to accept the risk. You know, the movement we get is X. The chances of it being a surprise are quite low because not everyone really is looking at this data. Everyone expects it to be in line. So I might hold it. So in that case, you might hold it and believe the risk is acceptable to you. It's not going to wipe out your account. You don't have a huge position size on. You've got a reasonable cushion as well, and that's just a mental thing. And maybe if you've been holding it since down here, you say, well, worst case scenario, I give back half or I give back all of it. I'm prepared to do that because I'm really looking for a kind of 2-day move after this, and I don't really want to close it here because it might get a bit of a spike after it. Of course, your other option is to close it here and reopen it afterwards. There's no problem doing that. But maybe you think that actually I might get a little bit of an extra boost from it. You know, I'm prepared to hold it. So, you know, something to consider is, you know, what the expectation is, what the amplitude move normally is, and what your position size is. If you're a big position size, guys, you probably don't want to do it because, you know, at the end of the day, anything can happen. You can have a really surprise where you don't expect it. Bang, it moves down 300 pips on you. And if you're in a big size, it rips your face off. That's just not what you want. So measured risk, I think, is, again, never a recommendation, guys. Just my opinion on this is, if you accept the risk and you've accepted the worst case scenario and you're still okay with that, then fine. This is for day traders as well as swing traders. So about stock through earnings. Now, stock through earnings is slightly different because very often, guys, if you're in a stock that's a bullish stock and it's running on, the expectation is mostly that the earnings are going to be good and continue the move, because the reason the stock is bullish is that the supply-demand imbalance is in the shift of demand. Lots of people think that the stock is going to do well, and earnings may well give it that boost. And if you're not in during the earnings, you don't get the boost. Now, of course, there's a flip side to that because you're completely giving up risk to this event. You're completely saying, here's the risk, off we go. And I know there's a risk going to come out, there's a risk event could come out. I don't have control over this trade at all. So that's the downside of it. So again, a very similar type of approach. A little bit different with stocks because you don't know what the earnings, you don't have an idea. You know, sometimes with data like non-farm payrolls or interest rate announcements specifically, you know they're not going to do anything. You know that the likelihood is we're not in a kind of interest rate changing cycle. It's going to be on the hold. And some things, as I said in the press conference after, whatever. I don't expect anything unusual. So you think the expectation of an extreme move is quite low. Earnings are a little bit different because when you're holding stocks over earnings, you just don't know what's going to come out. Now, it's going to depend on what stock you're holding. If you're holding a bellwether stock that's has very little difference in earnings, sometimes they're good, sometimes they're bad, and maybe it moves at 3 or 4%, you could take the risk and go, you know what, maybe there's a 4% risk to the downside for me. Is my position size big enough to stomach that? okay, yeah, I'll hold it because I think I'm going to get a boost. If you're trading high-tech stock, a cloud stock, software stock, any of these things that, they can just suddenly go from very poor earnings to ridiculous earnings, and all of a sudden that means their company's transformed, you could have 20% move on it. So again, understanding the vehicle you're in, the position size you're in, what's the worst case scenario for you, and saying, can I stomach that? Because the last thing you want to be is surprised by any move. Now, obviously, if you still decide to hold it over earnings, you're thinking, you know what, again, I feel like I've got a bit of a cushion in this trade. I'm prepared to take the risk for the upside that actually the earnings are going to be good and it's going to give me a boost to the position and support the position moving on, and I'm prepared to take that risk. So it comes down to, rather than just a coin toss or this, it's a clinical decision. What's the risk on this? What's the worst case scenario for me? Am I happy to hold for the worst case scenario? Yes, I am, because I believe the worst case scenario chances are very slim. I think that the better chances of being reasonably neutral, and there's a better chance of being a good case scenario for me. Can I stomach it if it's worst case scenario? Still, is it the end of the world? No. Right, I'm going to exchange that for the opportunity to have like a binary lift up and a good lift up in the position. So it's a thought process that goes into it, guys. I think it's a little bit of a science and an art combined. I think the worst thing you can do is to think of it as a gamble and go, oh, I'll see what happens, because inevitably you don't see the hidden risk. You don't see that actually it's very important earnings, because everyone's looking at one number that you didn't think, and that's like going to be a 10% move one way or the other just on that. And maybe that 10% is way more than you wanted to risk. So do a little bit of due diligence. Take some time to work out the impact of the data or the earnings, the potential impact of it, how that might affect your trade with your trade size, how that might impact your P&L overall, and whether you can stomach it. And if you can, then by all means, utilize earnings as a tool to get the growth. Utilize these as a tool to help the trade along. I'm not against taking binary risk like this or uncontrolled risk like this. I think if you're a beginner trader, then trading over this is probably not great. And if you're just trading just before earnings, just on a hope, then that's not a strategy. But if you've had a trade for a while and you're thinking, I don't want to close over earnings, I think it might give it a boost, then you can make the decision. You can make the decision for yourself and go, yeah, you know what, I'm prepared to hold it. I'm going to trim the position a little bit, add it back on just in case it goes crazy. Otherwise, prepared to take the risk. Or you go, you know what, I don't want to take the risk. I'm going to bank the profits out of this trade now, and I'm going to see what happens afterwards. If I have to pay up again to come back in, I will do. Otherwise, I'll take a next strategy. And the final thing is, guys, if you're in a losing position and you're hoping that earnings or data will claw you out of it, then you really don't want to be doing that, because you're literally pinning all your hopes on an event that is completely out of control. And that's not scalable. You can't do that over time. You can't consistently repeat that setup and hope that it's working for you. It's not the greatest approach. So anyway, guys, those are my thoughts on holding Forex trades over data or stock trades over earnings. Let me know what you think in the comment section below. As always, take care, keep the risk managed, and I'll see you in the next one. Bye-bye.